Hello and welcome to this week's webcast. Not only the ECB, but also the Fed and many other central banks are exiting the policy of easy money very hesitantly. In most countries, falling unemployment no longer seems to be pushing up inflation. The Phillips curve, demonstrating the negative link between unemployment and inflation, appears to be passé. In fact, though, the influence of the unemployment rate on inflation is being overshadowed by other factors. The first is inflation expectations. Since inflation has been falling since the early 80s, those in employment have lowered their inflation expectations. Now in pay negotiations, they are asking for less to compensate for inflation. This is why inflation is lower today, not because low unemployment has not in itself raised inflation. The price of oil too has overshadowed the impact of unemployment on inflation. True, it doesn't have a direct impact on core inflation, which the Fed is watching closely, as this excludes energy prices. However, oil is an important pre-product. If, as happened 2 years ago, the price of oil drops, the resulting cost reduction trickles through the entire value-added chain and dampens core inflation. Since the oil price has not retreated further in the meantime, this inflation dampening effect should ease slowly over the coming quarters. When statistical analysis takes into account the distorting effects of inflation expectations and the oil price, there has in fact been a clear influence on core inflation by the unemployment rate in recent years, in both the US and the Eurozone. All this means that US core inflation should move back towards 2% over the next few quarters. The Fed can be expected to raise rates more than the market currently expects. This would favor the dollar, putting pressure on the currency and bonds of the emerging markets. Thanks for listening.